Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to talk about investing in certain financial businesses. Specifically, there's news on Blue Owl that came out a few days ago, and I'm also going to talk about like insurance companies, banks, lenders, things like that, and why I have certain rules that I follow that help keep me kind of out of trouble with these sorts of businesses. So I'll start with a story on Blue Owl, which has made headlines. Probably you've seen it if you're on the internet and you're watching this video interested in finance. So we have Blue Owl calling off merger of its private credit funds after the announcement rattles the stock. So this was, let's see, the firm had planned to merge its smaller non-traded, I think this was a closed-end fund, with their publicly traded one, and in doing so, they restricted the investor's ability to redeem money until that whole deal was closed. On its surface, that doesn't really necessarily mean anything bad has to be happening. So what I'm about to say really doesn't have anything specifically to do with whatever Blue Owl situation is or the market reaction to it. Well, it does have a little bit to do with the market reaction to it. But it's not specific to them. I'm just going to kind of explain my philosophy about why I don't buy things like businesses like this, given the history that we have with it so far. So now that I'm reading this, it says even as the merger would have meant about 20% paper losses based. So I don't know if maybe they needed to mark that closed end fund to market in order. I'm not sure about exactly what the details would have had to happen in order for this deal to for them to merge the two together. But whenever a company prevents people from taking their money out, that can cause a panic, and that is basically what we had happen. Blue Owl, I did see Blue Owl's CEO commenting against the J.P. Morgan, or maybe the Jamie Dimon, I should say, comments about cockroaches in finance, which I did make a video kind of talking about that a little bit. But I think Blue Owl's CEO kind of said "not us" or something like that. You can look that response up. I just happened to catch it on Bloomberg when that whole thing was happening. So we have these sort of questions about private credit going around in the market. And let's go to the fast graph here. So, and I get asked questions about I haven't made a video on them, but about Blue Owl and a few other newer I'll just say financial companies in general, and I'll kind of go over one or two of them. So here's the deal. So they have asset management as their thing, as their industry. But when it comes to a business that is lending money or providing financing, or an insurance company that's covering policies that could have redemptions or claims, insurance claims down the road. So basically they're, in the insurance company's case, they're taking in the money now that they may have to pay out in the future, or with any kind of financier, you're lending money out now with the idea that you will be paid back, so you may not be paid back. It's a little different, but the problems for the investor are the same for the public investor. And that is, we don't know how much risk these companies are taking. We just simply don't know. And I think for some reason, like just saying I don't know is like the hardest thing for people to do, especially in our culture now, where it seems like, well, people will watch this channel and I'll see comments sometimes where you can just tell where, if it's something I say I don't know something about, they'll be like, well, why are you making a video? If you're not an expert and you can't tell us exactly what's going to happen 10 years in the future, then, what are you doing here? And sometimes you need to start from a position, one, just because you don't know all the information doesn't mean you can't make a decision that has certain odds associated with it. So that's one thing. So when I'm looking at certain metrics that I care about, it's because they have in the past they've had a high probability of producing good results, right? But that doesn't mean that if there's 10 companies that meet those metrics, and 80% of the time, which generally is like kind of the number that I seem to hit or aim for, those work out or at least produce positive returns, and 20% of the time they don't. When I go to buy those stocks, if there's 10 to choose from that all meet the same requirements, I don't know what 2 are going to be the losers ahead of time. So if I try to, you can get into a lot of trouble if you try to pretend like the 2 that are the most likely, and you put all your money in them, and then they go bankrupt or you lose money. And instead I say, well, I know my process is good, and I don't know which 2 are going to perform the best or which 2 are going to perform the worst. But if I buy all 10, chances are 80% of them will produce positive returns, and a couple of them will produce really good returns, and a couple will produce really bad returns. And I don't know ahead of time which they're going to be. So it's better to say I don't know, so your strategy matches what you actually do know. And you do know that historically the odds have been in your favor, but you have to have enough a sample size big enough statistically give you the chance for the strategy to work over time, right? So you have to have some statistical, not a lot, but like some basic statistical knowledge to understand that. And you have to be able to kind of get rid of this expert bias, or I don't even know what bias you would call it, where you feel like you have to know everything. And then the more work you do, the more certain you become in your mind, and maybe more convincing to other people in my experience. But the results are much worse potentially when you're wrong. So you can be very convinced and still do all the work and sound convincing to everybody else and be very, very wrong. So that person will probably make more money in this business than me, even though they lose people money, because I try to just be straightforward and say, well, I don't know which of these 10 are going to be the winners and which are going to be the losers, but I pretty good history and on my side that 8 of them will produce positive returns and 2 of them will, for different reasons, be losers. Okay, so with all that said, I don't invest in companies where I can't assess the risk and I don't know what risk they're taking, especially when they're new companies, like new publicly traded companies. So Blue Owl went public during a boom, which is also a big warning sign, okay? Not specifically to them, but when I look back, if I would have seen, okay, these guys went public in 2009, okay, when everything was horrible and the market was still, and investors were still willing to give them money in 2009, and then they produced very good returns since then, that is a very different kind of mark in their favor than when you go public at the peak of a bubble, which is what they pretty much did in 2021. So when all this capital is floating around out there and it's just available for anybody that can go snatch it up, just go look at all the SPACs and all the other IPOs that are, half of them are down 90% or bankrupt by now. And those are people that are going into the public markets when there were a lot of not very well-informed and experienced people investing in the market. Okay? So when you go public during a time like that, I'm always going to be more skeptical just off the bat. So that would be one mark of kind of skepticism about risk and how much risk or the business model or whatever they're doing. Does that mean it's always right? No. I'm sure there's great businesses. I probably have bought a few of them that went public in 2021 and 2022. So it doesn't completely write them off. But in this sort of business where you're making investments and you can get good returns, usually the higher the returns and the faster you grow earnings, like they've done they've kind of diminished here, but 52%, then 23, then 18, then 7 this year. So we're down to single digit earnings growth within a few years. The incentives are to take risk that doesn't fully be realized until farther in the future. So, or hopefully not realized at all, right? But you can always tell yourself that it's not risky when you're earning enough money in the short term from those incentives, right? And so that's the risk. I'm not saying that's specifically what happened with them or will happen with them, but there's no way, in my opinion, let's say if there was a way, I don't think there is a way to really fully do it from the outside. But if there was a way, it would take a lot of work on the other person's part. So sometimes there might be some like short report out there on the internet as somebody who's done like a ton of deep research on this somewhere, which I didn't look for, but on them, or you could pick any other similar type of company, where after the fact, somebody will go back and look and say, oh, this, Muddy Waters wrote something about them, and we all should have paid attention, and it was out there, like Big Short type stuff or whatever. But I am not going to do that work. So one, I don't think I have the talent to do it, specifically with like insurance companies and finance companies. I don't have enough experience in those industries to be able to read between the lines and know exactly what I'm looking for and know warning signs or have connections to people who may have heard something. So I know that's not like a talent set of mine. And so I'm not going to try to pretend like it is and put a bunch of effort into it only to be wrong and lose a bunch of money. So my way of dealing with it is just to avoid them. So when people ask me about it, well, the first couple of years here, I would say, well, they've only been public like less than 2 years. I don't buy any stocks that have been public less than 2 years. We'll say almost any. I think I bought one company when it was just barely almost 2 years that I was pretty familiar with. And it was in the industry was like a vanilla type of industry, like not real vanilla, but like just plain industry. It wasn't anything fancy. But for the most part, I need at least 2 years of data because all the incentives are for people to make the company look as good as they can in those first leading up to their IPO and in the year or two after. And then when they have to, reality kind of sets in, then usually the stocks fall like 80%. These guys didn't fall that much out of the gate. They actually, what were they here? 15 a share and then fell to, they lost almost 50%. But a lot of them will lose like 80%, like in the first 2 or 3 years. Then usually I look in and I say, okay, now that pessimism and is gone and all the enthusiasm is gone and maybe a little reality is set in, now is what's the long-term prospects of the company. So that's when I like to come into like a growth business and take a look at it. But then when we move past the 2-year mark, I would say, okay, what industry is this in? If it's lending of any kind or insurance, pretty much of any kind. I just say, I want a recession. I want to see what they do in a recession because that is when you find out how much sometimes it depends on what type of recession, and a company can get through one type of recession and not be prepared for another type of recession. We had a very different recession in 2020, in 2020, that was a very different recession too. But in like 2001, it was very different than 2008, right? So certain companies could do well in one of those and maybe not in the other, depending on the industry. But that aside, when we go through a down business cycle, when credit gets tight, when stresses are put on the market, when people can't pay back their loans, and that echoes through everything else that's going on, when vendors don't pay their bills, right, or customers don't pay their bills, then we get to see what what the risks really are have been taken in these companies. Or in the case of insurance companies, if you're, I don't know, doing property insurance in Florida and you had a run of 5 or 6 or 7 years when there was no major hurricanes in that area, and then one comes through, and during that time you were writing insurance cheaper than everybody else, so you were growing your company faster than everybody else, and then finally a hurricane comes through and you don't have enough, you realize, hey, we weren't charging enough premiums to cover that, then that's when it can kind of rear its head, right, in that industry. So you have to, so for me, I want them to go through at least one big stressful problem. If it's a bank, I want to see what they did in 2008. If they barely survived, and had a hard time recovering, sometimes banks can change their lending practices and the people that are in charge of them and the types of lending that they're doing and their typical customers and all that. But usually they don't change that much, right? And sometimes lessons can be learned, but I want the ones that would have been okay even if there hadn't been any bailouts in 2008 and recovered quickly and so forth. So does that mean they'll be perfect afterwards? No, not necessarily, but it dramatically increases the odds without doing a bunch of work on my part, right? Or having inside information or anything like that. So I want the stressful situations to be there. So we haven't had a stressful situation yet for Blue Owl because they've only been public during a bull market, basically. And what happens is, when there's no history there, you also see how jittery this market can get. So the folks that have bought in the past 2 years are all underwater. And off the peak, we're down almost 50%. So just shy of 50% in less than a year. And we haven't even really had any damage yet, right? So this is just people getting, earnings growth slowed, right? So that explains some of it. They grew earnings 18% last year, only set to grow 7% this year. But it's at a pretty low PE relative to the market. But that's probably because, and there's going to be people that look at that and just look at the PE, but you do have to, and granted, this isn't going to be perfect because the part of their business is probably, lending out money, but they have almost double the total enterprise value as their market cap. At least like 80%. So if you include that, then you need to almost double that PE. You're probably up in the high 20s PE with 7% earnings growth, which isn't that good, right? They really do need to do what people are expecting going forward. And they were also, I thought they did like a big deal with the data centers financing and stuff. I mean, that could be risky. So it's understandable that if you have folks or just a business, I mean, the people that work there have probably done this for a long time, but it might not be strong enough to go through something bad, right? And so another one I get asked about a lot is Kinsdale Capital. This is more the insurance story. Again, we have a longer history, but not going back past 2017. Earnings growth has been fantastic. People that bought are probably up 10x. Yep. Even today. However, now we see there's some worries getting built in here. And I don't know exactly what those are. But the thing is, it's like you really don't know how much risk there is. And there's always going to be stories about, oh, no, these guys know. There's not much risk in the way that they do things, blah, blah, blah. I'm just talking generically or whatever, because that's what I hear, kind of about these guys too. They do some sort of property insurance. And often they'll be doing things a little differently than has been done in the past. And that's the story of why they're able to make more money. And maybe that will be the case, but I am not willing to bet on it. So I'm just, the one clever, and maybe the Kinsdale will be the guys that do it. They get through the next recession and keep their 10x return intact. But most of the time that's just not, it's too good to be true, basically. The markets just aren't that inefficient most of the time over the long and medium and long term. So if all this money they've been collecting over the past decade was out there for anybody else to collect without taking on extra risk, then, they've done a fantastic job of doing it. But everybody's out there trying to make an extra dollar. And then when you go 15 years, and it's been more than 15 years into a bull market, there's a lot of people that don't even understand that like a recessions and things like that can happen, that unexpected things can come at any time, true black swans. And again, this is anything specific against them. It's just against all these types of companies where risks are hard for the average investor to even get a grip on and understand. And banks are the same way to me. So I want to see, maybe I should pick, what's an example of one that maybe we'll do, let's do JP Morgan. It's not the best example because it's so big, but I can go back and show that they lost money during the Great Recession, or that they actually didn't lose money, but the earnings fell like 50% or more. But they remained profitable. Yeah, they fell almost 70%, right? But they remained profitable, and 1, 2, 3 years later, they were back earning the same amount that they earned going into the Great Recession, right? So that lets me know that if they haven't changed things too dramatically, they can probably get through another really bad situation. And they've been kind of choppy during these times too. It's no guarantee, but I would rather put my money here if it's trading at a decent price than maybe one that I actually bought, UMBF. Yeah. So smaller regional banks. So here's what I'm looking at. You go back and you look here, and their earnings, they didn't have dramatic earnings growth, but you could tell that they hadn't taken on too much risk when you consider all the banks that went under or needed super bailouts during that time. And so I've bought this one twice, and I've made a lot of money. I bought it during this downturn. I bought it during this downturn, and I made very good money both times. I don't own it now. But you can see the difference here between this and, I'd have to pick one that like actually went out of business. But you can find some of them that were losing money, and then they just kind of barely survived and came back. So I can go back, or just some new bank that popped up. One I get asked about a lot from Brazil is New Holdings, right? So again, this is another example where diversified bank, they're in some sort of banking. Now it doesn't have I guess it's a 20 PE, so it's not super cheap, but it's another one where it could be a great business. Like it really could end up being a great business. This is what the stock price has done. It's not up a crazy amount since the IPO or since the US IPO, because I think maybe they're listed someplace else first, but I don't know that for sure. But again, we have a company that came out during the peak of the boom, immediately fell 65% in a couple months after that, and then clawed its way back up to maybe like a 50% return. Yeah, since then. But just not a long history. I don't feel like it's really been tested. I have no idea what kind of risks there are to their business model. And I want to see them go through like a real recession and then start coming out of it. And at that point, I might be like, okay, now I consider buying it. And this is another one I get asked about quite a bit. So it takes some willpower to just be like, and humility to just say, okay, this could turn out to be a great business, but I know 9 out of 10 times that if I buy any kind of company that's doing any kind of lending or insurance, that if they haven't been tested, then I have no idea what kind of risk they're taking. That's just my approach to all these. And it's saved me a lot of money, generally speaking. And if we have a recession, we're going to, or any kind of global calamity, I think, we're going to see a lot more stress on these types of companies. And all three of these that I showed here, they could end up doing great. But I want them to be tested before I consider buying them. So hopefully that, at least maybe weightings wise, if you can't, sometimes there's things you just can't resist, but maybe keep the weighting small if you find that you can't resist. If somebody else has something really compelling for you out there, just until something gets tested, and hopefully it can save folks a little bit of money. Thanks for watching, everybody. If you found this useful, if you found my lack of knowledge and insight useful, hit the like and subscribe button, and I'll see everybody later.